Welcome, everyone. I'm Miss Mancy, and I am just thrilled you're here for this comic book explainer. We're reading The Tale of the Two Runners, Understanding EMAs. Stepping into technical analysis can feel, well, a little intimidating at first, right? But I promise you, it absolutely doesn't have to be. We're going to take a really gentle journey together today. Your trading education should feel empowering, so get cozy, and let's just dive right into our story. Our story starts with a beautifully simple truth. Price movement leaves clues. The stock market isn't just some random jumble of numbers on a screen, it actually speaks to us. It leaves these little hints and footprints along the way. Technical analysis? Well, that's really just learning how to listen to that voice. Doesn't that kind of make you curious about what the market is trying to tell you today? To read these clues, we use some special tools. Let's look at one of the friendliest ones out there, the EMA. That stands for Exponential Moving Average. Now, I know it sounds like a big, scary math term, but let's just toss all that jargon out the window. An EMA is literally just a tool that calculates the average price of a stock, but it gives a lot more importance or weight to the most recent prices. It basically just helps us see exactly what buyers and sellers are up to right this minute. All right, there are two specific EMAs I want to introduce you to for our comic book journey. I like to think of them as two very unique followers on a path. On one side, we have the 10 EMA. This is our fast follower. It looks at the last 10 weeks of price action, so it reacts super quickly. On the other side, we've got the 20 EMA. This one is our slow follower. It looks at the last 20 weeks, taking its time to show us a more medium-term trend. Different timeframes just show us different rhythms of the market. Okay, let's visualize this. Imagine a bright, really fast car traveling down a long, winding road. In our story, this leading car represents the stock price itself. The car is always in front. And that's actually a crucial lesson to tuck away. The price is the ultimate leader in the market. Everything else is just following that car. Now picture two runners sprinting after that car. Runner 1 is our 10 EMA. Because he's only carrying 10 weeks of data on his back, he runs way faster and can easily catch sudden changes in the car's direction. Runner 2 is our 20 EMA. He's carrying 20 whole weeks of data, so naturally he runs a bit slower and takes more time to turn those corners. So the 10 EMA is always going to react to what the car, the price, is doing first. So let's watch our chase sequence unfold. Step 1, the car suddenly speeds up, surging forward down the road. Step 2, because the car is moving so fast, our quicker runner, the 10 EMA, sprints and completely catches up to the slower runner. Step 3, with this huge burst of energy, the faster runner actually blasts right past the slower one. And you know what? This sequential buildup is exactly how chart patterns form right before our eyes as a price goes up. And that brings us to the real climax of our chase scene. When the 10 EMA crosses above the 20 EMA, it is the exact moment our fast runner catches and passes our slow runner. I really want you to feel completely clear on this. A crossover isn't some complex, magical mystery. It's just a highly visible milestone on your chart that proves momentum is shifting. So what does this crossover actually mean for us? Well, when the fast runner passes the slow runner going up, we call it a bullish crossover. It tells us three beautiful things. Recent buyers are getting stronger, short-term momentum is improving, and the stock might just be entering a fresh upward phase. Basically, it signals a really positive, healthy shift in the market's balance. But before we get too excited, let's take a quick step back. I want to ask you a really crucial question to help ground your strategy. Is this crossover a magical guarantee that the stock price will rise? The honest truth? No, it's not a guarantee. And honestly, that is perfectly okay. The market deals in probabilities, not absolute certainties. A crossover is just a signal, a clue that the balance between buyers and sellers might be changing. I want to reassure you here. Technical indicators are incredibly helpful guides, but they aren't crystal balls. And knowing that actually makes you a much safer, smarter trader. All right, let's step out of the comic book for a moment and look at a real-world example using the INFY weekly chart. Looking at INFY's current numbers, the market price is sitting at 1173 rupees and 80 paisa. Our fast runner, the 10 EMA, is down at around 1160, and our slow runner, the 20 EMA, is up higher between 1190 and 1200. So what's the takeaway here? It shows that right now, INFY's recent price strength hasn't fully changed the main trend just yet, because our fast runner is still trailing behind the 20 EMA. But what happens if that car starts speeding up? Let's walk through the stages. In stage 1, if the INFI price rises to 1200, our fast runner, the 10 EMA, will start sprinting upward faster. Then, in stage 2, if the price keeps rising to 1250, the gap between our two runners is going to shrink, and eventually the EMAs will meet. This is exactly how future price action literally pulls our runners together on the chart. So where exactly are they going to meet? Well, based on the current math, the estimated meeting point for this crossover is somewhere between 1210 and 1225 rupees. That's where the intersection is statistically expected to happen. Having this kind of precision really helps build trust in the process, doesn't it?
Now here is where it gets absolutely fascinating. When that crossover finally happens on the chart between 1210 and 1225, the actual stock price, the car, is expected to be way up between 1250 and 1280 rupees.
I know exactly what you might be thinking right now, and it's a wonderful question. If the crossover is happening down at 1220, why in the world will the INFI price already be trading so much higher near 1260? If you're feeling a little confused by that gap, please don't worry. Literally every beginner asks this, and the answer is actually quite simple. The gap exists because the EMA is, by definition, a follower. Think of a really gentle image. A small child following his father through a park. The father walks ahead, creating the path. The child follows, happily behind, reaching that exact same spot just a little bit later. The price, the father, creates the movement. The EMA, the child, confirms that movement later. That's exactly what we mean when we call it a lagging indicator. Because we're following the path later, we have to look at probabilities. Let's be totally transparent here. The confidence that the EMA crossover will happen near 1210 to 1225 is about 70%. The confidence that the price will be near 1250 to 1280 during that time is about 65%. But notice that bottom row. The confidence that a crossover alone will give you a profitable trade is definitely lower. Smart trading is about calmly assessing these odds, not just blindly trusting a single line. So the crucial point is, why isn't it 100%? Well, because markets are wonderfully, beautifully unpredictable. Global market conditions change, unexpected news can just drop out of nowhere, or even a single negative week of trading can delay our runners from crossing. I share this to protect you from false confidence. The market is a living, breathing thing. And this brings us to how you can really grow and level up your skills. Professional traders do not buy a stock just because they see an EMA crossover. They look for the complete picture. And I want that for you too. I want you to feel so proud as you grow from reading a single clue to reading the entire story the market is writing. To read the whole story for INFY, we need supporting evidence, extra puzzle pieces to make us feel fully equipped. First, we'd want to see the weekly price close securely above 1250. Second, we'd want the RSI indicator moving above 50. It's at 46 right now, meaning momentum is improving, but it's not fully bullish yet. Third, an ADX showing a strong trend, which it actually does right now at 35. And finally, we'd want to see increasing volume. All these pieces must validate the story our two runners are telling us. If there is one golden rule I can give you today to really lock in your understanding, it is this. The crossover does not predict the beginning of the move, it confirms that a change has already started. EMAs are confirmation tools. They're not fortune tellers. They just validate the clues you are already seeing. Let's bring it all together and summarize our journey today. For INFY, the current price is at 1174. Sustained buying by the market is needed to push that car up to the 1250 to 1280 range. When that happens, it's going to pull our fast runner up, causing the EMA crossover to happen beautifully around the 1210 to 1225 mark. And just like that, you've walked through a complete, professional, technical analysis. I am just so proud of the time we've spent together today. You now know exactly how to safely read the market's clues. But here is my final question for you. Now that you know the runners always follow the car, will you use this to chase the market or to anticipate where the road leads next? Thank you so much for joining me, Miss Mancy, for this explainer. Until next time, happy and safe trading.